you. Today is Tuesday, April 28, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. So, if you remember yesterday, we talked about scaling a company, and I think that we ask a simple question: Can we or can the business grow without putting too much weight on the founder, right? And today we're moving into the second portion of the advisory board operating system, which is predictability. So where the growth and capital from the asset lens today is going to be about three assets: the partnerships, the revenues, and the assets, meaning the physical or intangible assets that a company might have. So let's pull the model here so we have the visual cue of what we are going to do. So this is a full advisory board operating model. So you see you have four big milestones in your organization always, which is scaling, predictability, your systems with not necessarily a software all the time, and your edge, your transformation, your innovation, what makes you relevant in the market the next quarter, the next semester, the next year, etc., etc. So let's go into the section that we're going to comment today, which is this section, which is partnership, revenues, assets, and the predictability, and particularly predictability when you're looking into raise capital, which is the examples that we are following this week. So here is where how I can put this: the mood in the room changes, right? Yeah. Why? Because yesterday, we talk about going to market, how the founder dependency or the founder idea sometimes have to be bring down to whatever the market really is looking for in terms of say, yeah, we are comfortable with this in terms of growth or scaling. And today is about the money when you need the cash, the capital to do that. So money asks colder questions. When you're talking to investors or to entities, private equity, venture capital, or financial entities, or it could be banks or lenders, etc. You start to see a kind of a pattern of questions that are coming together all the time, and I give you a few. So is the revenue repeatable, right? And you say, well, we have repeat customers. I say, yeah, well, we need evidence that repeatability, right? It might not come that straightforward at that point, but you start to perceive that actually they are start to look at this kind of question. So I boil it down to the core question just to make sure that you are prepared for these kind of things. So the other question will be, are the assets clean? And you will say, what do you mean with that? But for example, if you have equipment or vehicles or a building, so all these have logs in terms of maintenance, health and safety, insurance, etc., etc. Do you have that paperwork up to date or the valuation up to date, right? Is the valuations are in the third party, for example, for if you own a building or a warehouse or a block office or a block office block or whatever is the case, is the valuation up to date? Because if you have a valuation that is old, perhaps 2 or 3 years ago, that valuation today probably might be irrelevant because they say, well, but we cannot take that into account because it's 3 years old, right? Are the contracts clean? That's the other question. I say, are your contracts with your suppliers or your customers, when they are going to expire, how they are securitized, are they with insurance or not insurance? Do you have a policy regarding those? For example, if you are providing services like a company we discussed last week, and they had 1.5 million, I think 1.3 million of collection due for 9 months. And the questions start to come across, like I say, hold on a second, what's going on with insurance now, right? When they were raising capital, and they say, we are just pretty much due to collect these 1.5 million, so we are going to have enough amount money, right, to securitize this loan, etc. And then the question of insurance came through, because actually, if the services, literally services, were delivered 9 months ago and were not collected yet, the insurance of those services, where they stand today, because if there is an issue and it's still in the guarantee period and the insurance is not covering that, that collection probably can easily turn around to be a debt rather than a benefit, right? So you have to be careful with these kind of things. And this is when this question is related to how risk is priced. So how much it costs us if these situations are happening. Well, so this remind me also that last week I was talking to a funder who believes his company is ready to capital because the market is pulling him in, right? So he has calls and interest is curiosity. It doesn't mean revenue. So, but as an advisor, the view and knowledge are different, right? So it's not what you perceive that you have and you're doing, because it's all in your head many times, and which is a good thing, but actually you start to need to document all these things in a way or how. So in these cases, the next step is not to go right into fundraising, even if you think that you have enough evidence on your or movement in your organization for a raise. The next step is to make the company fundable, right? And what I mean is that the difference between excitement, because you see, oh, the things are going in a way that we need more capital to go and to do next step, something that we spoke yesterday about is scaling. But in terms of predictability, you start to collect evidence that fundraising and particularly the company are prepared for that. And that's where I come in as a board advisor. I put an international rotating advisory board around the milestone in front of your company. So the organization gets the specialist capability needs in a fraction of the time it takes to hire one executive, for example, without a big consulting overhead, without the talent locking, and with the members swapped every 6 months. So as the project evolves, because one thing is a specialist to raise capital, then how to deploy that capital is another set of specialists that you need in your organization advising. So the risk I want to talk about today is the false fundability, right? Yesterday we talked about false scalability, when you think that we are ready to scale, but probably you're not that ready to scale as you think. And today is the false fundability, when you think we are ready to raise, and probably you're not that ready to raise as you think. So the false fundability sounds like this. And if you start to hear this when you're raising capital, probably you need to stop and reconvene with your team and say, let's take a second look at this. If you think, if you start to hear or put in your pitch deck that you have a high demand, you have increased sales, that you have increased partnerships, that you have IP documented or patents, if you have a big market to serve, if we only need capital to move faster, those probably are literally red flags for any investor or capital that you are looking for, right? So because that is not evidence, that is all true, that don't get me wrong, but investors don't fund a list of claims. They fund a case that they can check, right? And what you need for checking? Evidence. So let's take a look at 3 problems today about this situation. The first problem is revenue is not predictable just because it exists, right? So usually you look into, this is our last 3 year trajectory, this is our tax returns, you name it. But a company can have sales and still not have a reliable revenue, right? And this is a case of a company that we are talking today. They are raising capital. They have almost 140 customers. They are very well diversified from small customers to large organizations. But guess what? All the business is based on the relationship of the owner that is retiring. There are not formal contracts in place, none. So you can imagine that is a very, very dangerous situation, because the next person that is going to, or the next organization that is acquired this company, they don't have the relationship from 1978 that this founder started this company, right? So it's almost 47 years of 46, 47, 48 years of relationships. Yes, 140 customers that today they are still repeating, is a repeat customers, but there's nothing formal there that actually you say, yes, we can predict revenues and forecast revenues for the next 3, 4, 5 years based on these contracts, on these terms and these conditions and these engagement clauses, right? They don't have it. So that is a kind of a tricky situation, because you say, yeah, we see the numbers in the past, but what will happen in the future? That's what I'm talking about, predictability. So as a board, as the executive team, and yourself as a funder need to understand the repeat orders, margins, cash timing, customer concentration, delivery costs, and how much of those sales depends on you, not on contracts that can be executed by any professional team. In the case I mentioned, the gap between collections and revenue is called out as a review point. All the time they're going to, let's review this again, let's review this again, because there's no enough conviction there that actually this company is predictable when the owner leave the organization in a couple of months. So that matters, because the capital will look at that quality of the money, not just the amount, right? So be careful when you're saying we are very good collecting, and we are very good, we have excellent revenues. Look where that revenue is coming from when you're using that as an evidence of the health of your organization. The second thing is about your assets. Um, Assets are not valuable if the board or the executive team and the founder cannot prove where they sit. And we are talking about different things. We are going to about the product itself, your intellectual properties, your contracts, as I mentioned, your data, your brand, your customer proof and distribution rights. All of them matter as your assets. But if the paperwork is unclear, the values becomes harder to price, right? So you have to have all these very well documented, as I mentioned earlier. The route the company should follow is to review where the assets, the IPs, the patents, the contracts, and the commercial rights sits before pushing ahead with capital. And there's one thing that you have to consider too, where these companies are, how the structure of the company is put together. Is a limited company, an LP, is a C corp, or a limited company, or a public listed company, where there is a branch of organizations working together under a holding company. So all these things matter, because when you're going for capital and there is not clear where the things are sitting, particularly in jurisdictions or different countries, if you're going international, that is very hard to value, because actually if there is something wrong, and here's the point, the capital always look what is going to happen, or how to de-risk their investment, right? So you say, oh, you want everything for yourself. No, it's not everything for yourself. It's because when you have chaos, guess what happened? It's very hard to track and to understand where the things are going and how the things are managed. And that is the risking, is understanding what is going on, what potentially could happen, and the measurements for those potential things that might happen. Because when everything is smooth, everything is smooth and good, right? So where is the problem there? But when you start to look into how to de-risk an investment, that is where you as an owner, the founder, the uh, executive team, or the board of advisors have to put the things in the right order, in the right sequence, to make sure that this fundraising is a successful one, right? So the third thing is actually I want to mention is not the lack of capital, by the way. So many perception is actually, oh, it's a big problem. There's no money in the market. There's plenty of capital in the market. And I have statistics here from the UK where they say the private capital says that 9 billion was invested in British businesses in 2024, and that was up by 13% from 2023. And this is the last statistic, so we don't have other numbers that support that. But 9 billion was invested in private capital by private capital. So it's not a lack of capital. It's just a matter of, are your company fundable? So that tells you capital exists. So, and there is something else. EY says there were only 2 IPOs in Q1 2026 in the UK, right? So that what is telling you these things? It's telling you the market is still selective, right? Because 2 IPOs in 2026 seems to be very, very, very reduced. So it's only 2 IPOs in full quarter. Well, but put simply, the money is available, but the weak proof gets punished, in other words, right? So what I mean with this is actually, if you cannot prove all these things that we are mentioning, provide the evidence and put it together in the right sequence, then it's not the money is not going to flow into your bank account, unfortunately, right? So Why I'm telling all these things is not to say it's not a pessimistic view of the world. It's like okay, now we understand how the things work. So then, how we can position ourselves, our organization, our board, our teams, our company, to be in the right place at the right time. So, how lucky can we make ourselves very lucky? Just putting the right things in the right place in the right sequence, right? So in other words, imagine that raising capital is like going through an airport security, right? So if you go into the airport security, you might have your hotel booked, your car booked, your holidays booked, your everything ready, and you might have a very good reason to travel. You say, I need a break, I need a weekend off or a week off. But if your documents are not in order, you're not going to pass through security, right? So you might have everything perfectly done, planned, paid, and ready to go. But if your passport, for example, is expired, you're not going to take that plane, unfortunately. So be careful how the things you are doing, because actually sometimes these small details are what prevents what when everything else is in the right place, in the right direction, and with all the right players in the right position. So as a board and executive founder, you have to ask a better question, really. So what must be true before we ask the market for money? So as a board advisor, I would propose the following for your consideration. Number one, build a revenue quality sheet. Show revenue by customer type, show repeat versus one-off, show margins, show the cash timing, show the top 5 risk to the number. So show what happens if the founder is not involved in the sale, for example. Now, the second thing I will consider is build an asset ownership sheet. So where does the IP sit, the intellectual property? Which company owns the contract? Which entity invoices the customer? What is licensed? What is protected? What is assumed but not documented, right? So a board should never have to guess where the value lives. Board, your executive team, or yourself as a founder. And the third thing to consider is build a capital readiness sheet. What is the amount being raised? What is the use of the funds? What proof supports evaluation? What risk would an investor find in the due diligence? What needs fixing in the next 30, 60, 90 days, right? So having all these things pretty much start to give you the highest possibility to have a successful raise. So the next challenge and is to who is going to help a board or executive team and a founder to do this thing, because you already have enough in your plate every single day just to start to think about these things. So we have 24/7 in a week. We cannot have more hours or more days added to the things that we are doing. So who is going to help you to clean everything up without killing momentum? That's where I come into play. So I give you 3 things very clearly: business outcomes, differentiators, and risk reductions. In terms of business outcomes, I help boards, executive teams, and founders to turn capital ambition into a fundability plan, right? So that means a company can move from we need money to scale to we can show investors the revenue, the asset, the partnerships, and risk in the way they can trust, right? Because you don't want to hide the risk either. You want to say these are the risks that we found, and these are measurements that we put in place, right? So in terms of differentiators, I build a rotating international advisory board around the capital milestones that you have. So that may include investor readiness, revenue quality, IPs, taxes, legal structures, market entry, financial modeling, and capital route design. So you have everything in one place. You don't have to have many teams trying to do this. In terms of risk reductions, the model reduces the risk. The advisory operating system model reduces the risk of going to investors too early, damaging valuation, exposing weak documents, or creating avoidable doubts around the founder, right? So it gives the company a cleaner route to capital without the overhead of a large consulting firm. Perfect. So one action you can take home today, and it's doable in 30 minutes or less, before your next meeting with your executive team, with your board, or yourself as a founder, ask for 1-page fundability score with the 3 columns only: partnership, revenues, and assets. So mark each one red, amber, or green, and add 1 sentence of evidence for each one to score, right? So there you will have at least in 1 pager where your partnerships, your revenues, or your assets are in a good shape or a bad shape, but based on evidence, right? And shaping is about going to the gym. So it's a matter of getting in the routine, the momentum, the rhythm to get the things in a way that actually can be repeatable and predictable. Now, if you're a founder, if you are an executive team, part of the executive team, or a non-executive director, or a part of the member board, and you want an international advisory board to help you organize and test your fundability, improve your capital readiness, or build the right proof around your next raise or market entry, let's have a 30-minute call so I can understand where you are today, what you want to achieve, and how a rotating international advisory board can help you to move faster without hiring one permanent executive or paying a big consulting overhead. Excellent. Let's pause here for today and reconvene tomorrow, because tomorrow I will move from capital to systems, because clean numbers only matter if the operating system and not necessarily software. So all the systems in your company, your standard procedures, your workflows, etc., can hold up when the growth starts moving faster, right? So it's a big engine in a weak structure may not be the good idea either. So have a great day, and